You've been told that crashes are accidents, that chaos is natural, that markets move like wild storms, unpredictable, violent, and completely random. But what if I told you that chaos isn't random at all? What if every crash you've ever seen, every panic, every liquidation, every red candle that looked like the end of the world was not the failure of a system, but the proof that it works exactly as designed? See, the markets are not living organisms. They are machines. Machines built from numbers, algorithms, and emotion, precisely programmed to extract behavior. Every participant in this machine, you, me, the institutions, the exchanges, plays a role, and every role has a mathematical expectation of loss and gain. But here's the twist. Your role, statistically speaking, is not to win. It's to create liquidity for the ones who do. Now imagine a perfect system that thrives on volatility, one that doesn't fear panic. It feeds on it. Every time retail confidence peaks, the system quietly prepares for extraction. Liquidity builds like air pressure before a storm. Orders stack, emotions rise, and volatility compresses into silence. That silence isn't peace. It's a trap. Because silence in the market is never natural. It's engineered tension. You've heard the term controlled demolition. It's when a building collapses not from weakness, but precision, each column detonated in sequence to create the illusion of chaos. Market crashes are no different. Every algorithm, every derivative, every margin system is a fuse. The timing is mathematical, the destruction deliberate. They tell you it's panic selling. Retail investors dumping positions. But look deeper. Who has the margin data? Who can see your liquidation levels, your stop losses, your portfolio exposure? The same entities who design the system that trades against you. That's not chaos. That's choreography. When a crash begins, it looks spontaneous. But the math behind it has been running for months. Risk models analyzing exposure, volatility algorithms measuring fear response, sentiment tools mapping emotional exhaustion. Crashes are simply execution points, moments when the collective behavior of the crowd aligns perfectly with the system's need for liquidity. They call it rebalancing. They call it correction. But in truth, it's the moment when the market machine harvests overconfidence. Controlled chaos, that's what it is. Here's how it starts. Retail gets comfortable, the market goes up, volatility falls, and everyone forgets fear. Small dips get bought instantly. Every red candle becomes an opportunity. It feels safe, and that feeling of safety is the most dangerous signal in finance, because safety means leverage. Leverage means exposure, and exposure means potential energy waiting to be released. Behind the curtain, models track every inch of that exposure. They measure not just positions, but emotions. When traders stop hedging, when put volume dries up, when volatility products collapse, it signals one thing: belief. That's when the system knows it can flip the switch. So one day, a small event hits, a data miss, a geopolitical rumor, a liquidity drain. On the surface, it's minor, but the algorithms don't see headlines. They see imbalance. Orders flood in, liquidity evaporates, spreads widen. What looks like chaos to you is actually a mathematical cascade. Every sell triggers another. Stops trip, leverage unwinds, and panic spreads. But to the system, this is just calibration. The math cleansing excess. Retail panic is the liquidity event. Every loss you take is fuel that resets the machine for the next cycle. Now, here's where it gets darker. They call it market efficiency. The idea that prices reflect all available information. But in practice, efficiency is just extraction disguised as order. The market isn't trying to find a fair price. It's trying to find your breaking point. Institutional models know when you'll fold. They simulate how far a price must fall before the average leveraged trader gives up. That's not theory. That's math. It's coded into their volatility algorithms. Every crash you see is a mirror reflecting back your own psychology. Fear, greed, denial, hope. It's a behavioral equation. The math doesn't predict markets, it predicts you. Look at how the news reacts during a crash. Unprecedented event, unforeseen liquidity crunch. But the data shows something else. Volatility spikes were forming weeks in advance. Liquidity metrics were drying up, and institutional hedges were quietly being loaded. By the time you see the chaos, it's already been priced in. You're watching history delayed. And when the crash is over, what happens? The same experts who predicted nothing suddenly emerge with perfect explanations. They talk about interest rates, inflation, and catalysts, but never the real mechanism. Control through mathematical uncertainty. Because uncertainty is the perfect tool. It keeps you guessing. It keeps you trading. It keeps you providing liquidity. The machine survives only because you believe it's uncontrollable. That belief is what gives them control. Controlled chaos. Think about those two words. The paradox hides the truth. The chaos must be real enough to scare you, but controlled enough to not destroy the system. Every crash wipes out the weak, resets the metrics, and prepares the ground for another rally. Another illusion of stability. But what if you could see the math behind it? What if every candle wasn't a random motion, but a data point in a larger equation? You'd start to see patterns, volatility clusters forming like storm fronts, option gamma exposures creating artificial gravity, liquidity vacuums timed perfectly with retail exhaustion. The more you look, the more you realize this isn't chaos. It's design. And the most terrifying part? The design works because it exploits the one resource that never runs out: human emotion. You don't need to manipulate prices when you can manipulate beliefs. You don't need to crash the market when traders will do it themselves out of fear. That's the real genius of the system. The chaos is self-sustaining. All it needs is participation, your participation. Every buy, every sell, every anxious refresh of your portfolio is an input. You're feeding the equation. Now zoom out, look at the cycle. Calm, overconfidence, volatility compression, shock event, liquidation, despair, recovery, hope, and then back to calm. It repeats not because of randomness, but because of human memory. The market doesn't crash, we do, over and over again in mathematically predictable intervals. So the next time you see a crash, don't ask what went wrong. Ask who benefited. Ask who was already positioned. Ask who had the models that said the system is ready. Because when billions are lost in minutes, that's not a bug, that's a harvest. The system doesn't destroy value, it transfers it. From panic to preparation, from confusion to control. Every crash is redistribution masked as disaster. And once you understand that, chaos stops being scary. You realize it's not random at all. It's an operating cycle, a controlled demolition of belief. They call it volatility. They call it risk. But underneath the noise, it's all math, predictable, repeatable, and weaponized. So when you see the next collapse, remember this. Someone somewhere is calm. Someone somewhere is collecting data. Someone somewhere has been waiting for this exact equation to complete. Because chaos isn't their enemy. It's their business model. And that's the difference between surviving the market and being consumed by it. So if you're still chasing patterns, still believing that every crash is a new story, step back. You're watching the same movie on a different screen. Controlled chaos. The illusion of randomness, designed to look like disaster, but built to maintain control. The market was never broken. It's working perfectly. Because when everyone screams accident, the architects smile. Because the system isn't designed to prevent crashes, it's designed to need them. That's the mathematical beauty of destruction. That's the order inside the chaos. And now, you know why they call it the market cycle. If you found this breakdown eye-opening, don't just walk away. Go deeper. Watch the other episodes, The Greed Paradox, Signals, Courses, and Lies. They don't manage risk, they manage you. Because every piece connects to the same puzzle, the system of belief. Hit that subscribe button, like this video, and explore the next truth, because in a market built on illusion, the only real power is awareness.